Hello and welcome to this week's Ferrari Financial Market News Summary. Well, we predicted a bit of consolidation for the beginning of the week, and that's exactly what happened. A good attempt at a rally in the first couple of days, but as we expected, there was another leg down to this market, and the Nasdaq Composite Index crashed through the 2,500 barrier right down past 2,400 without a pause. And this was despite the Fed pushing in 120 billion into extra liquidity for the banking system. But this didn't seem to be enough to quell investors' credit worries, and it really wasn't until the end of the week when the Fed finally stepped up to the plate and cut the discount rate by 0.5% that really placated the market and caused the rebound rally we saw on Friday. We have to ask ourselves, though, is this going to be enough to keep the rally and the recovery going? Because investors really want to see this spill over to the Fed funds rate with a rate cut at the September meeting or even before. We feel that nothing short of this will really give the market the confidence that the turmoil of the last few weeks is over and that this can be really regarded as a correction rather than a long-term downtrend.
We're going to take a look at the one-year chart for the Nasdaq Composite Index because I want to focus in more close-up detail on the sell-off feature that we've had since the middle of July when, as we predicted, the market did top off and has been falling really ever since, except for a small bounce it took off the short-term moving average line, which is this line here, and you can see this little bounce back that happened last week. The Friday rally that we had on the Fed news of cutting 0.5% off the discount rate has brought us back to this level here, but I want to show you three scenarios really on the chart. The first is a nice simple one, which is that we would draw a trend line, short-term trend line, cutting through these last 3 points really where the market took a bounce. And you can see how the market has returned each time from the short-term trend line. It attempted to again last week but failed, and the significant penetration down to just under 2,400 indicates to us that the likelihood that the market will continue to follow this trend line upwards is quite low. Our second scenario really is more probable, and that is that we've established probably a barrier range or a channel range between this level here, which is where the market went up to last week before deciding to turn south again, and the level that it bounced back from on Thursday night, which is this level here, which was actually 2,380, and this channel range here is quite a wide trading range that the market could well stay within for the next few weeks. The last scenario is probably the worst of the three because even though I don't show it going back a lot further, over the last 3 years a much longer term trend line has been established, which again passes through this point but is a much shallower line, and if I was to extend it back and then forward extrapolate it to this point here, it would actually touch the scale, the price scale, at around about 2,100. Now we do feel that a right shoulder could be forming here over the next few weeks, maybe within this channel that we've established, and then there could be the inevitable penetration of the 2,400 line that was established this week. And then the next stopping point, in our view, would probably be down to this trend line here at just over 2,200. So we'll keep a very close watch on the markets in the next few weeks to see which of these scenarios looks like is unfolding. But certainly our best guess at the moment is some more consolidation within the channel line that's been established here, with the possibility of the head and shoulders scenario forming with a right shoulder out here and then a drop down past the 2,400 down to as low as 2,200.
Well, that second down leg certainly was quite something, bringing us down to below 2,400 for the Nasdaq. We've reached a little bit of a support line which existed before the Fed's announcement, but it was the Fed's announcement of the 0.5% cut in the discount rate which really brought about this rebound rally. But the news from the housing front just seems to get worse and worse, which is not helping with consumer confidence, as evidenced by the Michigan report during the week. Our feeling is that this is not over yet, and it might be an idea to get out of the long positions you may have taken at the beginning of this rally and start going back into a short position, because we do feel that certainly the 2,400 level will be tested again in the next few weeks. And we can't help but feel, as shown by the chart, that the long-term trend line, which is hovering at the 2,200 level or just above, is beckoning the market downwards. We feel this is probably the only point that the market will really take a long breather and consolidate properly before taking its next move, which hopefully will be upwards from that point. Well, that's all for now. Until next week, it's goodbye from London.